morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Trump's tariffs take effect. Levies hit an 100-year high. Import taxes arrive for dozens of U.S. trading partners and an 104% tariff on China. Market dysfunction. Global bond markets convulse, sending U.S. 30-year yields soaring to touch as high as 5%. And China holds fire on immediate retaliation, but allows the yuan to sink to a record low. Beijing reportedly plans its next moves. This is when the orderly market sell-off starts to look disorderly. Since Friday's close to now, the 30-year yield is up some 40 basis points. At one point, we were touching 5%. At one point, the biggest sell-off for this bond market since 1982. This is the kind of move caused by a forced liquidation of leverage trades being unwound, of a fire sale of the most liquid asset. But here's what happens when a foundational part of the financial system starts to break down. The knock-on effects across the globe happen. 40-year yields for Japan rising at one point, the highest since they debuted in 2007. That's about 18 basis points now. Your UK 30-year yield also climbing to the highest since 1998. This stock market also flipping back and forth between gains and losses. At the moment, we're posting gains. We're up 0.1% for your U.S. future session. NASDAQ is 0.5%, while Russell 2000 falls 0.4%. We are still 12% lower since the reciprocal tariff announcement. Meanwhile, crude oil falls 3.2%, so there is still recessionary bets going on in this market. It is an important hour. You do not want to miss the conversations we're going to be having. We're going to be speaking with Sharon of Goldman Sachs and Priya Misra of JPMorgan Asset Management. But back to our top story. Global bond yields continuing to push higher this morning with reciprocal tariffs here and now. With a look at the market action is Bloomberg's Valerie Teitel. Val, is this some disorderly moves or what?
Look, this is really starting to beg the question, are we about to see some major market dysfunction when it comes to the Treasury market? The three-day move in the long end, Danny, is something we've not seen since March 2020, when there was a failed 30-year auction and the Fed had to ride to safety. That is a very concerning move, a lot of concerning price action in the Asia session overnight. I want to flip on and just talk about one thing that could possibly be to blame, which is this narrowing of swap spreads, Danny. That is basically telling us that there is not enough dealer capacity. There's not enough balance sheet capacity to absorb this forced liquidation of the Treasury market. And also to that, guys, Danny, we do have some further auction events, let's call it that, like major market catalysts for the Treasury market. We have a 10-year auction today and a 30-year auction tomorrow. Remember, it was an auction that really spurred the major market dysfunction back in March 2020.
Yeah, and we already saw a not very good 3-year auction yesterday. Valerie, thanks so much for breaking it down for us. Bloomberg's Valerie Teitel. So President Trump's tariffs have now hiked levies to an 100-year high as of midnight, reordering global trade. And on the eve of the implementation, the president spoke at the National Republican Congressional Committee dinner.
And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch, legendary in a positive way, I have to say.
Our team coverage on tariffs starts right now. Bloomberg's Tyler Kendall joins us in Washington, D.C., and James Mager in Beijing. Tyler, let me start with you. The filter out of the White House yesterday morning was one of negotiation. By the evening, it was one of escalation. Where do we stand now?
Yeah, good morning, Danny. Well, it really depends on which trading partner we're talking about, right? Of course, with China, we saw that escalation when it came to stacking those tariffs on top of each other, coming to 104% going into effect at midnight. But with other allies and trading partners, it does appear that the White House is welcoming the outreach, right? We had President Trump yesterday saying that he had a productive call with South Korea's acting president and that a trade deal for that country was looking good. We have also learned that the U.S. appears to be giving priority to Japan in future trade talks. And President Trump now saying that each deal is going to be tailor-made, not off the rack. Those are his words when it comes to the future of the tariffs here. And We even had Treasury Secretary Scott Bessent yesterday, for example, saying that they're taking an ice cube approach, that an ice cube only gets smaller with time, and that if countries don't retaliate, this is going to be the highest level that those tariffs end up being. But we would be remiss if we didn't mention, Danny, yesterday, President Trump really appearing undaunted, particularly by the market's reaction. We are, of course, focused on these reciprocal tariffs, but important to note, President Trump vowing that some more sector-specific tariffs are coming. He said that the pharmaceutical sector tariffs would be next and coming soon.
Tyler, can we get into that? What exactly would tariffs look like on specific sectors? It's something Trump had talked about before, and again, talking about it increasingly now.
Yes, definitely. Well, this administration has floated, particularly for pharmaceuticals, it could reach up to 25%. And we know that they are looking at invoking what's known as Section 232. As you well know, the administration has already invoked this to put into place those steel and aluminum tariffs, as well as tariffs against automakers. And it essentially would first, we get some sort of a heads up that this was coming, because it first kicks off an investigation and then later the implementation of the tariffs on grounds of national security. Now, President Trump has also floated some other sector-specific tariffs that could be coming down the pipeline, including on lumber and also copper imports, all saying that this is necessary, not just for economic reasons, but for those national security concerns, so that the U.S. can bulk up its own supply. Of course, as you well know, this would have wide-reaching impacts, because these tariffs would likely be stacked on top of the existing tariffs that we're already seeing.
And speaking of stacking tariffs on top of tariffs, James, that brings us to China. 104% tariff on China now coming into play. The immediate reaction from the Chinese, we haven't seen it, but reportedly a meeting is planned. What might we get out of that, James?
I mean, I think one thing before we get to that is important to remember is there's actually not 104% tariffs, because Donald Trump put tariffs on many Chinese goods in the first administration. Joe Biden added to those during his administration. And so compared to where we were in, say, 2017, are you looking at, some goods from China have, multiples of 100% tariffs on them now. But, the reaction, as you said, we haven't seen retaliation being announced by the Chinese government yet. Based on past, how they've acted in February and March, we were expecting something to happen at midday Beijing time as soon as the U.S. tariffs went into place. That didn't happen. But we may see something later today. There was reportedly a meeting today, of the senior leadership, Xi Jinping and the rest of the Politburo, to discuss what to do about the Chinese tariffs. To discuss what to do about the U.S. tariffs. I think, and if we do see something, it will be similar to what we saw last week, which was higher tariffs on U.S. goods. It was investigations into American companies in China. It was restrictions on exports of critical minerals and rare earths. It was also, they added a bunch of U.S. defense contractors, drone makers, and other companies to the Chinese equivalent of the entity list. And so we're likely to see more of those things today. And you're also seeing in the FX market, the Chinese central bank is clearly allowing the yuan to weaken, which will make Chinese exports more competitive and will blunt some of the effect of those tariffs. Whether they can weaken the yuan enough to allow, to blunt a large portion of the effect of those tariffs without causing Chinese investors and savers to try and get their money out of the yuan and sparking capital flight or not is still to be seen. But you see the central bank in the market today telling state banks how to sell and how to buy dollars to sort of control the speed at which the currency is depreciating.
James, to that point, do we risk a trade war turning into a financial war right now, given what the Chinese are saying, with the PBOC is reportedly asking banks to hold back on those U.S. dollar purchases and the allowed devaluation of the currency?
It's very possible that these moves could lead to unexpected consequences in the financial market. In 2016, when the PBOC tried to devalue the currency, they sparked a massive capital outflow from China because people suddenly wanted to get their money out, and so these kind of actions, even though people think they're in control, can have these unintended consequences. You're seeing in the treasury market today that the yields are spiking as well. So it's quite possible that an action on the trade front, whether it's higher tariffs, whether it's export controls, can lead to unexpected consequences in other markets, in financial markets, in the stock market, wherever. It's impossible to say that it's definitely going to happen or it's not going to happen. But the risks of those kinds of things is definitely rising.
James, Tyler, thank you both so much for your time this morning. So much to go over. By the way, George Saravelis of Deutsche Bank warning that we are headed for a financial war. It might shift from a trade war to a financial war. Also writing that they're warned about confidence crisis in the dollar. Events over the past few days are, in our view, validating those fears, because we are witnessing a collapse across U.S. assets. Okay, let's get to some other top stories that are trending on your Bloomberg terminal this morning. Ray Dalio is warning that investors aren't paying enough attention to a once-in-a-lifetime breakdown in the geopolitical and monetary order. The billionaire Bridgewater founder blames these underlying conditions for leading to the tariff disruption that has been dominating market action. He says bigger disruptions are still likely to come. The largest seller of eggs in the U.S. reported a 247% surge in profits last quarter after prices rose to a record high. Mississippi-based Cal-Maine Foods also acknowledged it had been contacted by U.S. authorities investigating price fixing. The ongoing avian flu outbreak forced farmers to cull some 30 million birds so far this year. And demand for used gold Rolex watches is on the rise. The price of the precious metal has risen more than 10% this year. The Bloomberg Subdial Watch Index, which tracks prices for the 50 most traded models, has 3 gold Rolex timepieces, climbing the most places up in the index since it was launched in 2022. Coming up, stocks teeter on the edge of a bear market. We're going to discuss with Sharon Bell of Goldman Sachs next. You are watching Bloomberg Brief.
This is a bit of a panic moment for the market, and it is reminiscent of March of 2020. And in that type of environment, no asset class is immune from these potential dislocations. So I think technicals are certainly at play. Fundamentally, I think investors might be questioning the long-term investment case for the United States. And I don't want to go too far with this idea, but a lot of countries around the world own U.S. treasuries. And could they use that as a retaliation tool? I hope not.
Yes. Ruptures in global bond markets after U.S. tariffs come into force. Let's get the reaction from Europe with, again, European bond yields moving higher in the UK, the biggest spike to the highest level in 1998. And now a 20% levy in force against the EU. Bloomberg's Oliver Crook joins us from Brussels on this. Oliver, is there any space for negotiations with reciprocal tariffs now here?
I mean, that is certainly what European policymakers and leaders and citizens, frankly, alike are hoping for. So far, there has not been any really indication that the Trump administration is willing to have those discussions. But, Danny, I think it's worth just taking a second to mark the moment here, because the EU, when you look at the trade data from last year, this is the bloc that was the biggest exporter to the United States. We're talking about more than 500 billion euros worth of goods that come from the EU into the United States. You put 20% on that, that's 100 billion euros of costs annually that need to be distributed somewhere from the producers here in Europe to the consumers in the United States. And over the last few hours and the coming weeks, that is going to be figured out. Who is actually going to be paying for this? For the policymakers here in Brussels, they're going to be voting on measures a little bit later today in retaliation, not to the tariffs from today, but the tariffs from a few weeks ago on steel and aluminum. They're going to take a very sort of modest approach in imposing those tariffs. It's only going to be about $20 billion worth of goods that they're going to target. It's going to be some of the things that the U.S. exports, like motorcycles, boats, some appliances, poultry, some agriculture. But they may not even start collecting those tariffs in May. The reason for that, Danny, is they want to give themselves as much flexibility as possible to get some of these negotiations with the Trump administration. But as we've been reporting over the last few days, they don't seem very inclined to talk. And Danny, maybe that will change next week. We have the Italian Prime Minister, Giorgia Meloni, going to the White House, hoping to get some concessions or to get at least some idea of what the United States wants. While, Danny, at the same time, you have the Spanish Prime Minister, Pedro Sanchez, in Beijing on Friday. He has been talking about, with all of this uncertainty, potentially having a closer relationship with China. So this is really ripping through not just the markets, but also the geopolitics here in Europe.
A really interesting development. Oliver, thank you so much for keeping us on top of it. That is Bloomberg's Oliver Crook. And European equities under pressure this morning, down 2.4% as U.S. futures flip between gains and losses. Sharon Bell of Goldman Sachs writing, quote, "We would argue that we are in an event-driven bear market triggered by tariffs. However, it could easily morph into a cyclical bear market given growing recession risks." She's a senior European equity strategist and pleased to say that she joins us now. Sharon, thanks for joining us on quite the morning. So how close are we to tipping in to something that looks like more of a fundamental bear market driven by a recession?
Yeah, we're getting closer by the day, by the minute, aren't we, at the moment? And I think if this does tip into recession, and that looks extremely close now, then a typical cyclical bear market, you see falls from peak to trough of about 30%, and we're not there yet, I'm afraid.
I feel like we have to continue to ask this morning and most mornings as we see the selling action happen. Sharon, as an equity investor, what do you look to act as a circuit breaker of the current dynamic that we're in right now?
The circuit breaker that's typically the case, and this was true in the pandemic, for example, but it's been true in various other instances too, is policymakers shifting. So this could either be a shift in tariff policy, for example. That doesn't look likely at the moment, but any easing on that front clearly would be powerful for the markets and a huge relief. And then the other thing would be monetary easing as well. But at the moment, given that tariffs are, certainly for the US, likely to be inflationary, there's less room for Powell to really shift on rates. So yes, it would have to be a policy pivot, I guess, of one sort or other, that will help to provide markets with relief.
It was previously, to start this year, Sharon, with the expectation of tariffs coming in, was that it was bad for the U.S. at a time that Europe was starting to spend. And that meant that you could see European equities rally. The opposite is happening, at least for today, at least since we got the implementation or the announcement. Sharon, is there any sign that that rotation might come back? Or is it a case where the U.S. suffers, but the rest of the world suffers more?
I don't know that the rest of the world suffers more, but the rest of the world certainly suffers. Europe is essentially a large open economy, very dependent upon global trade. So if we're talking about a global trade war and that continuing to heat up, Europe is not going to be a beneficiary of this. Europe is going to suffer too. And as for whether it suffers more than the US, one thing I would say is that there are some cushions for Europe. Europe has already opened the sort of fiscal piggy bank, as it were, for Germany. You're starting to see a bit more spending there. I think Europe could do a little bit more in terms of that. You can also, because I think this should be less inflationary for Europe, there's more room potentially for policymakers to ease monetary policy as well in Europe. So there are some things that help, but honestly, Europe being large, open economy is going to be hit by these global trade concerns. The other thing, of course, is European currencies have been stronger recently, and that hits European earnings too, and there are a lot of dollar earnings for European companies.
Well, to that point, if you're a market participant, you can react day to day to the headlines. You can react to whether it seems like the White House is negotiating or whether they're escalating. But if you're a company, Sharon, you need to make CapEx decisions that span over years. So what are the scars of the uncertainty of this moment and companies' willingness to commit to CapEx and to hold on to employees?
Yeah, absolutely. I mean, this is what causes, in some ways, your recession, a lack of investment. The uncertainty, I would say, is more powerful than the tariffs themselves, because you'll get lower employment. You'll also get lower investment too. But I think there's also an additional rinky-dink, as it were, to this for Europe. Europe has spent the last 10, 15 years pivoting towards the US and investing in the US. And both sort of investors have done that, buying the Mag 7, buying the US stock market, etc. But also corporates have done that, moving more of their assets to the US. But is that more questionable now, particularly if the dollar is weaker, particularly if there's lots of uncertainty about who you wish to trade with, etc.? So I think that uncertainty is very high, and where Europe should wish to pivot to is also uncertain as well.
Yeah, that weaker dollar dynamic, really fascinating, brings to question as whether we're in peak U.S. asset ownership. Sharon, thank you so much for joining us. I know you have lots going on today, so we'll let you get back to it. Sharon Bell of Goldman Sachs. You're watching Bloomberg Brief. The reciprocal tariffs have arrived. And I got to say, just looking at markets themselves in the U.S., you would almost think it's calm. U.S. futures are higher. The 10-year yield is now just up 4 basis points. But at one point, we had a 30-year yield hit 5% in flips between gains and losses for the S&P 500. George Servais of Deutsche Bank calling it a loss of U.S. dollar confidence as the dollar weakens. Let's take a look at what's happening under the surface with some stocks to watch. Here's Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So keep an eye on the pharmaceutical stocks today after big losses in the European peers as Trump threatens potentially huge tariffs on the sector. And while it's unclear how this would affect the US names, we are seeing the likes of Pfizer lower on the pre-market. Then I'm also watching the Mag 7 with Apple leading gains after an upgrade at Jefferies that says while iPhone shipments are set to decline, a 30% slump for their stock year to date is well and truly overdone. And finally, Peabody Energy soaring in the pre-market as Trump signs an executive order expanding the use of coal in the United States. And also just the usual shout out for our Before the Bell opening wrap, running you through these and more on the terminal now.
An especially important day to take a look at that. Joe, thank you so much. Bloomberg's Joe Easton. Now let's get you some front page news, a look at what's making headlines around the world. It is all tariffs across the front pages. The New York Times leading with the U.S. implementing punishing tariffs on trade partners. The administration signaling that the White House was ready to negotiate deals, though, saying 70 governments have reached out so far. Wall Street Journal. They are reporting that Trump's tariffs put the Fed chair in a no-win situation. Levies pushing the economy towards a possible recession while simultaneously pushing up the price of goods. Jerome Powell and the FOMC caught between opposing arguments to either cut or hike rates in the near future. And a quick look at the FT leading with companies rushing to promise new factories in the U.S. being threatened by Trump's tariff chaos. Coming up, we get back to the conversation about bond markets. JPMorgan's Priya Misra joins us next. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Trump's tariffs take effect. Levies hit an 100-year high. Import taxes arrive for dozens of U.S. trading partners and an 104% tariff on China. Market dysfunction. Global bond markets convulse, sending 30-year yields in the U.S. soaring, at one point touching as high as 5%. And China holds fire on immediate retaliation that allows yuan to sink to a record low. Beijing plans its next moves. So reciprocal tariffs have arrived, and this is when the orderly market sell-off starts to look disorderly. Look at the 30-year yield at one point touching 5%, at one point logging the biggest sell-off since 1982. It's the kind of moves caused by forced liquidation of leveraged trades being unwound, but it's a foundational part of this market, and it has global repercussions. Japan's 40-year yield at one point rising to the highest since it debuted in 2007. In the UK, you're looking at 30-year yields at one point rising 16 basis points to the highest since 1998. Your 10-year yield up 6 basis points. With all of that, you think it would look really ugly in risk assets. Look at what U.S. futures are doing. They are gaining. The NASDAQ 100 is up 0.5%, but make no mistake, they've been flipping between gains and losses with other risk assets from Europe to oil falling. Oil down 3% this morning. So about 60 nations have been hit with levies. Starting today, U.S. tariffs are now the highest since 1909. President Trump spoke at the National Republican Congressional Committee dinner on the eve of tariff implementation.
And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch. Legendary in a positive way, I have to say.
Back with us is Bloomberg's Tyler Kendall in Washington, D.C. So, Tyler, what sort of tariffs is the world waking up to this morning?
Yeah, hey, Danny. Well, the highest tariffs in more than a century when it comes to what the U.S. has imposed. And of course, the big question remaining is what is it going to take to bring those tariff barriers now back down as countries come and start calling President Trump? Delegations are arriving in Washington trying to strike a deal. One thing that has become increasingly clear, it's going to take more than just eliminating trade barriers, eliminating tariff barriers, pledging to eliminate those trade surpluses these countries run, because that's exactly what we've heard from some already, like Vietnam and Israel, who don't appear to be on the verge of any sort of deal. In fact, that's why we're really going to be watching what sort of non-tariff barriers start to make their way into the conversation in a more serious way. Danny, yesterday, the USTR Jamison Greer was testifying on Capitol Hill, quite a time for this pre-scheduled hearing to happen. And he's told lawmakers that the U.S.'s message to countries that have other ways to achieve reciprocity is that the government wants to hear from them, indicating to us that some of these deals could get a little creative, as President Trump says that they're all going to be tailor-made, not off the rack in his words. But importantly, Bloomberg News reporting, per sources familiar, as of now, it doesn't appear that there is a formal established system for companies and countries alike to formally register their complaints with the USTR, the Commerce Department, the NEC, and that's only further complicating matters as these countries try to get their phone calls taken by the White House.
And it's not just country-level tariffs. We also heard from Trump talking about measures on coal, talking about measures on pharmaceuticals. What industry type of tariffs might we be getting soon, Tyler?
Yeah, well, yesterday, President Trump pledged that those pharmaceutical tariffs would be coming very soon. This is something that he has long talked about, including on the campaign trail, that pharmaceuticals was something that he is going to look at. And we know that that's going to definitely sound some alarms for our European Union allies. Other than that, President Trump has, of course, also pledged copper is going to be a key one here. And our Bloomberg News reporting that those tariffs could come sooner than expected. And then, of course, chips. Chips is going to be a big one moving forward, as well as this administration really tries to prioritize creating a more domestic supply chain when it comes to chips. It's been really interesting to watch how this White House really has taken more of a stick versus carrot approach when it comes to chip makers, with President Trump saying he prefers his tariff plan over the Chips and Science Act.
Tyler, thank you so much for your excellent reporting this morning. That is Tyler Kendall in Washington, D.C. Now, I mentioned that global bond markets have been under pressure. We've seen that in the UK with the 30-year yield rising to the highest since 1998. The BOE's Financial Committee meeting on April 4th and April 8th, we were getting some readouts from that saying that the risk of further sharp corrections remains high, that they are ready to raise or lower capital buffers if needed, and that the trade shift could harm stability by depressing growth. There is certainly concern of dysfunction this morning. I'm pleased to say that Priya Misra joins us now, portfolio manager at JPMorgan Asset Management. Priya, what a day for us to take you away from your desk. First of all, thank you so much for joining. Are we at those levels of dysfunction of policymakers needing to step into this bond market?
So we're certainly seeing this classic war shock. I mean, we've been seeing it in equities. Now we're seeing it in the bond market. So there is certainly market dysfunction. I would say with the bond market in the last couple of days, I think there's a couple of things going on. You know, people have to de-risk. And so if I've had trades on that have made money, sometimes you sell what you can, not what you want to. So I think that's happening. There's de-risking. There's a need for liquidity as margin calls are being hit. And then there's concern that the rest of the world owns a lot of treasuries. I mean, our estimate, about $8.5 trillion of treasuries are held by the rest of the world. If trade deficits, if the objective of tariffs, and it's not clear what the objective of tariffs is it to lower trade barriers? Is it to take the trade deficit to zero? But in that scenario, if trade deficits are zero, the rest of the world doesn't need to hold treasuries, doesn't need to hold dollar assets. And so is that $8.5 trillion being liquidated? I mean, I think it's too early to say whether that's happening, but I think the concern of that is what's letting rates rise. But I think there's an opportunity here. You know, this is a nightmare for corporates. This is a nightmare for consumers because inflation's going up. It's a nightmare for corporates. Your profit margins are being impacted. You know, costs are going up. Demand's going to get hurt. Funding costs are going up. And so I think a recession, I mean, we've been worried about uncertainty. Now you've got tariffs. You've got the DOGE-related government cuts. And so if you're heading into a recession, you talked about, I think, is there a policy response? Is there an off-ramp? Yeah. I don't know if it's here, but you're likely to see the economic hard data, which has been very resilient so far. That's going to start to weaken. I think that's when the Fed steps in. Now, they can probably cut rates. I'm not sure that helps. There's lags. If you do see the credit market seizing up, I think then you can see something else. That's what the Fed has focused on in the past. Credit markets have been remarkably resilient. Yeah. I mean, they are widening. Credit spreads should be wider as the probability of outcomes, you know, or the distribution of outcomes starts to widen. But we're still seeing the lower quality credit underperform the higher quality credit. That starts to shift and you start to see big outflows. I think then you're talking about the Fed coming in potentially with a policy put, in terms of a facility, etc. But we're not there yet. I think we're still trying. This has all happened so fast that I think first markets adjust and then the policymakers have to do something.
I mean, we're kind of in the land of economic textbooks, right? About these theories of what's going to happen and watching it play out. If we are in this world where there is less demand for U.S. dollar assets, where trade deficits are shrinking, where you don't have as much U.S. dollars abroad, how big of a paradigm shift is that? Because you could make the argument that that's what has supported valuations to the point where they are, that you have more U.S. dollars abroad buying U.S. assets. Are we talking about a complete reordering of financial markets too?
So the U.S. exceptionalism, I think there's structural components of the U.S. exceptionalism, which I think that might be a step too far. The, U.S. innovation, technology, large, deep capital markets, I think that is here. But there's a cyclical component. And I think that is what is being shaken out right now. It's a highly owned position, U.S. assets. U.S. assets had outperformed the rest of the world. The correlation between equities and the dollar, that's broken down. Now you're seeing the correlation between bonds and stocks breaking down. So I do think it's a big, to your point, I mean, if that's being unwound, I think that's bad for U.S. assets. But then you look at U.S. investors, and that's when you take a step back, U.S. investors have owned a lot of equities, and I think have under-owned fixed income. So at some point, we'll have to start focusing on how do people think about their total asset allocation. And if you're in, I would say intermediate, maybe you stay away from the very long end because that's a lot of duration risk. But the 0 to 5 year sector of the fixed income market is driven by the Fed. And I think what I struggle with is in all these moves, the end point of Fed rate cuts that the market's pricing in is about 3%. That's neutral. I think if we're talking about a slowdown, recession, the Fed's cutting a lot more. So that front end to me still seems safe. I know we have auctions and there's concern around, this sort of deleveraging can continue. But I think to the extent you can start legging into some short-dated corporates which are levered to this, is the Fed going to cut? I think at some point the Fed's going to look at inflation and then look at growth and say this inflation is supply driven, the demand side is not there, and they're going to have to cut, and they're going to have to cut a lot more than that 3% that's priced.
Do we just end up in QE to affinity? Is that where all this ends, Priya?
I think if the Fed takes rates to zero in a recession, if they go all the way down to zero, I think QE is the next step. I do think what they can do is they can start cutting rates, and if they need to do some, we're sort of reliving a little bit of COVID here. And what we saw during that COVID policy response was they did the monetary policy side, then they did other facilities. I think that might happen, along with the rate cuts. But for QE, I think the Fed funds rate has to be zero. We're very far from, we're at 4.5. So we first have to price in Fed funds getting to zero, and then QE might be the next step, especially if the rest of the world is not buying treasuries.
I got to say, the Fed is not sounding like that at all. I mean, you have Austin Goolsbee in the middle of a market meltdown saying we're worried about inflation expectations becoming unanchored. Is this a Fed that's become extremely reactionary and is only going to be cutting when it sees the labor market crack, when it sees the white of the eyes of the recession?
I think it's going to be hard for them to be preemptive, absolutely. They've got a dual mandate. Inflation's already above their target. And everything we're hearing from the policy side is likely to make inflation higher. So they have to wait for the data. The data has been very resilient. But that almost tells me that the later they start, the more they'll have to go. Because, then they know that policy works with a lag. So the later they start, if the unemployment rate's already at 4.5, and they're starting to cut, we know the Powell Fed is not shy. They started a little late in terms of the hiking cycle. They went in 75 basis point increments. So I think the easing cycle, when it starts, will be aggressive because at that point they've seen the cracks in the labor market. Yeah. And they're having to push back against the inflation, which is still above their target. So I think they will probably start late, but then go aggressive.
I just want to end where we started and just get the final word from you on what we're seeing in this bond market. I mean, the U.S. bond market, it is a foundational part of this financial system. Seeing some of these trades be unwound, the fire sale, at what point do you get worried about cracks in that foundation and the ramifications of it?
So I think some of this is classic flight to quality. We're seeing the difference in, between the off the run and the on the run bonds. it's still not, it's showing you signs of stress. I don't think it's at the point where we need the Fed to jump in. If credit spreads widen to the point where companies can't issue, they can't refinance their debt, I think that's when the Fed is going to say that the credit transmission mechanism is broken. I mean, right now, I think if you can be in short-dated sort of treasuries, I think that's sort of much safer. The long end of the curve is sort of a different animal. I think that's where risks are very high, particularly because the rest of the world owns a lot of treasuries.
Yeah, we're seeing that happen in real time. 30-year yields now up only 5 basis points at one point at 5%. Priya, thank you so much for joining this morning. We really appreciate it, especially on a morning like this. That is Priya Misra of JPMorgan Asset Management. Coming up, pharma next in the firing line. President Trump says that major tariffs are coming soon to the sector. We're going to have more on that next.
We're going to tariff our pharmaceuticals, and once we do that, they're going to come rushing back into our country because we're the big market. The advantage we have over everybody is that we're the big market. So we're going to be announcing very shortly a major tariff on pharmaceuticals.
President Trump last night speaking at the NRCC dinner, talking about pharmaceuticals next in line for major tariffs. Joining us now is Sam Fazeli, who leads pharmaceutical coverage for Bloomberg Intelligence. Sam, do we have any idea of what kind of pharmaceutical sectoral tariffs we might be seeing?
Yes, hi, Danny. So we don't know, but it's probably going to be along the same sort of lines that we've seen with other tariffs that the administration has put in place. And of course, you have two types of things. You've got products that are finished or almost finished in terms of the put in a vial or whatever in another country and then shipped to the US. And you've also got the active ingredients, which are the ones that are more likely to come from countries like China, where they are used for manufacturing within the US. And that would probably be much more of an impact on the cheaper generic drugs than it is on the more expensive and modern branded drugs.
The goal of this, as we heard from the president there, bring pharmaceuticals to the U.S. Sam, what would a process like that look like? And would companies even be willing to do something like that when it is just such an uncertain environment right now?
Yeah, so Danny, I think some of the manufacturing can be moved relatively, I don't want to say easily, because nothing is easy in this world of complicated inter-country products and supply chains, but relatively easily, and some would be much more complicated. And at the end of the day, not everything that you use in a pharmaceutical is going to be able to be manufactured within the US. And probably 1, 2, 3 years' time. A lot of pharma companies have already announced expansion of manufacturing within the US, Eli Lilly being an example, Novo Nordisk being another one, partly because they want to have their product near where the demand is. But the problem I have with this, Danny, if I may, is that we're also, the administration is also talking about penalizing companies on price. They've been talking about things like favored nation pricing. You can't entice them to come saying we're the biggest market in the world and then shrink that market to a point that doesn't make any sense. So there's a bit of a incongruence there.
Makes complete sense, Sam. And it's a lot for these companies to grapple with and a lot of decisions that need to be made. We're going to start to hear from some of them in earnings at the end of this month and early May. What in the world are they going to say?
Yeah, so given what we heard from the president last night, we were expecting, I'm assuming, some numbers on the in terms of tariffs today, tomorrow, or that sort of timescale, I suppose. The thing that they need to tell us is what happens to their complicated supply chain work, particularly their work by taking intellectual property into a country where the tax base is low. Take Ireland as an example, manufacturing there, transferring it with transfer pricing at much higher level to the US. So you end up paying your tax on that profit in a lower tax country, and therefore you make much lower tax in the US as you bring the product in at a higher price. So that's where I think the companies need to start, at the very least, giving indications as to where their tax is likely to go once they know how that transfer of manufacturing to the US is going to work.
Sam, really great to get your expert voice and opinion this morning. Bloomberg Intelligence's Sam Fazeli. Now, I mentioned earnings for the pharma sector, but we have earnings coming this morning. It is from Delta, one of the first major ones and major airlines to report since we've had tariffs put in place, since we've seen the market turmoil. Pleased to say that joining us in studio here in New York is Bloomberg's Sid Phillips. I mean, Sid, March we get a profit warning, even before we had tariffs. What are they going to say today?
That's the billion-dollar question. Everyone's looking to see what the airline industry is talking about, especially as sort of fares moderate, because remember, the demand that had sort of creeped up since the pandemic, the sort of boom in demand, a lot of that was led by leisure passengers. And if people aren't feeling sort of confident about spending, they might push back, and especially on premium sectors where they were paying for business class and premium economy, they might sort of start cutting back on that spend. So we're looking to see what the airline really talks about and how they sort of go and how they navigate from here. I mean, will they start pushing sort of lower fares in order to fill up planes? Because there is likely overcapacity given the fact that the airlines were expecting a bumper summer and sort of run up into summer. And so we're looking for any sort of commentary on what the airlines really are, what Delta is going to talk about in terms of what their outlook looks like, what their fare outlook looks like, especially with costs potentially rising and because of inflation.
I mean, the whiplash is really incredible, right? That you get airlines saying we're going to do well, maybe we won't, maybe demand's lower, and now tariffs. There's been kind of this story bubbling, Sid, and is there any credence to it, this idea that international travelers want to come to the U.S. less?
I mean, we are seeing it on some sectors. I mean, Canada most famously is sort of, we've seen a demand drop on flights from the U.S. to Canada. So we are looking to see what that impact will be because, I mean, there's also been the crackdown on the border with several countries talking about how it's not a good idea to, they sort of putting travel advisories on the U.S. And so that might actually also have some impact on people wanting to come and spend money and time and holiday in the U.S.
There's also this fear of supply chains. Over the weekend, Reuters reporting that Howmet, which gives supplies, gives crucial parts to various to Boeing, to the likes of Airbus, that they're declaring force majeure because of tariffs. Are we going to head towards another supply shock when it comes to airlines, when it comes to this industry in aerospace? Is that an inevitability if these tariffs stay on as they are?
It is. I mean, for the aviation industry, I mean, supplies come from all around the world. I mean, the parts that sort of go into a plane that's made by Boeing or Airbus come from suppliers all around the world. And for 45 years, the airline industry has virtually had sort of zero tariffs on aircraft and aircraft parts. And now we're sort of going into a regime where there are tariffs and then there are different tariffs for different places. And so we're looking to see what that impact will be on the supply chain, whether suppliers will be able to supply parts, will they have to look for alternative suppliers. You can't just find an alternative supplier overnight. It takes years and years, and you need certification of those parts. And so it's going to be a very, very complicated orchestra for the airline and the aircraft industry to try and navigate.
Again, this gets back kind of to the question we were talking about pharmaceuticals with Sam Fazeli. How do these companies commit to plans? How do they commit to plane orders when there is so much uncertainty? Is this a moment of almost a freezing of the industry when it comes to big decisions?
I mean, the aviation industry has seen big shocks. I mean, the pandemic being the sort of most recent example, and when demand came rushing back. And so, I mean, everyone's waiting to see what the actual impact is before they can sort of take decisions on whether or not they can actually get those parts, whether or not there's any demand on aircraft purchases, whether there's any sort of drop in flying. So, I mean, everyone's looking to see what that scenario looks like and take it from there, essentially.
Well, it's going to be interesting to hear what they report again. Delta earnings before the bell this morning. Sid, thank you so much for joining us. Bloomberg's Sid Phillips. All right, let's get to some other top stories that are trending on the terminal this morning. Ray Dalio is warning that investors aren't paying enough attention to a once-in-a-lifetime breakdown in the geopolitical and monetary order. The billionaire Bridgewater founder blames these underlying conditions for leading to the tariff disruption that has been dominating market action. He says bigger disruptions are still likely to come. The largest seller of eggs in the U.S. reported a 247% surge in profits in the last quarter, prices rising to a record high in that time period. Mississippi-based Cal-Maine Foods also acknowledged it had been contacted by U.S. authorities investigating price fixing. The ongoing avian flu outbreak forced farmers to cull some 30 million birds so far this year. And demand for used Rolex watches is on the rise. The price of the precious metal has risen more than 10% this year. The Bloomberg Subdial Watch Index, which tracks prices for the 50 most traded models, has 3 gold Rolex timepieces climbing the most places up since the index was launched in 2022. Well, what a day it has already been, and it is only 5:55 a.m. this morning, so let's get you set up for the rest of your day. As we're talking about with Sid, we are going to be getting Delta earnings before the bell. Plus, Richmond Fed President Tom Barkin will be speaking at 12:30 p.m. Eastern. What will he say? Is the Fed willing to step in to stem some of the pain in this bond and funding market? Then we're also going to get Fed minutes. Those come from the March meeting out at 2 p.m. Let's quickly get through some stocks this morning that are moving. Starbucks rising, Jefferies upgrading it to a hold, saying that there's limited near-time downside potential. It did drop 29% since its Feb high. Constellation Energy also up 2.7% in the pre-market. Citi raising the stock to a buy. Peabody Energy also extending double-digit gains as President Trump signed an executive order to expand the use of mining and coal in the U.S. All right, some breaking news coming from Germany this morning. Merz has sealed the deal to form a government, a German government. It will be formed with the Social Democrats, coming at a crucial time for Germany from Europe with tariffs being put on. What kind of spending will Germany be able to do, especially with bond markets looking as they do this morning? Is the fiscal headspace starting to run out for European governments? A question we have to ask as the move in bonds starting in the U.S. seeps into the rest of the market. German 30-year yields not doing a lot this morning. It is really on the front end of the German curve. We have moves. Meanwhile, you are looking at Japanese bond yields. At one point, the 40-year yield rising the most since that measure was implemented, that instrument was implemented. 18 basis points. Your 30-year yield up 7 basis points at one point this morning, touching 5%. Well, that is it for your Bloomberg Brief. Surveillance will track the market moves from here. This is Bloomberg.